Thanks for coming, people. We'll kick this off in about 2 minutes. By the way, during the talk, we're asking people generally if you can keep yourself muted during the talk. But if you do have any questions or comments, please do put them into the chat, and we will answer the questions at the end of the talk. Just feel free to throw them into the chat, and we will go through things then. We will be sharing some of our knowledge. We'll also welcome feedback, and really hoping we can get a good discussion going towards the end of the last part of the talk. So we'll start off with about a 30-minute presentation, plus or minus, and then from there we'll move into discussion.
Hello, Helmut.
Hi.
Hello, Ted.
So we'll just give the late arrivals 1 more minute, then we will kick off. And this will be a reasonably exclusive group today. It is a reasonably specialized topic, but hopefully it will be interesting for you, and would love the discussion as mentioned as we move on from here. All right, let's get things kicked off, just to reward you, those of you who are on time, and the others will join us as they come. This talk is really to address a question, and the question is, does venture capital need to be a liquid asset class? And just to give you a little bit of background on myself, I've been an entrepreneur for 20 years, 18 years investor, initially as an angel investor. I've spent 7 years both running and designing accelerator programs. For the past 3 years, I've been the founding co-managing partner of a company called Loyal VC, which has made over 200 investments. I actually counted it up. I've mentored over 500 companies. So I spent a lot of time thinking about what it means, just sort of looking at what it's like as an entrepreneur, as an advisor to multiple companies, as an investor, looking at the way the venture capital asset class works, and basically how money flows back and forth, how it's invested, and spent some time thinking about that, and here to share it. I mean, my background before, bank consultant, INSEAD MBA, engineering physicist. So of course, there's all the academic background to be able to look at some of these things and wonder about them. The fundamental principle which underlines venture capital is that venture capital is, everyone says venture capital is an illiquid asset class and should be an illiquid asset class, because the underlying assets themselves are illiquid. So in venture capital, it's a very long time to exit. It's about 7 years on average to get about half of the M&A deals from first investment through to exit, 8.5 years for about half of the IPOs. And of course, that goes back and forth depending on the IPO market. And 12 years typically to get over 90% of your IPOs. I have my best returning angel investment that I've made gave me 30 times my money back in an M&A. And that deal took 14 years to do. And I can tell you, if I'd exited that deal in 10 years, I might have made 4, 5 times. I would not have made 30 times. So the assets themselves take a long time to exit, and they also take a relatively long time to fail as well. The result is venture capital funds, when they are set up, have a conventional, straightforward structure. And I'll just give you a quick rundown for those of you who don't know it. A venture capital fund is a limited partnership. It's got an 8 to 10 year fixed life to match the expecting holding period of the assets. That is extendable anywhere from 1 to 4 years, depends on the rule of the limited partnership. You have standard fees within the limited partnership of a 2% annual management fee, sometimes higher during deployment than falling off, and a 20% carry share of the profit. And basically what happens is a general partner, who's the venture capitalist, will set up a fund. They will then raise money every 3 years. They'll basically set up a fund, deploy it over a 3 or 4 year period. That's fully deployed. They will move on, possibly with new partners added. We'll raise the next fund, go out and deploy that. And then meanwhile, the partnership, fixed term, at 8 to 10 year life, waits for those assets to be liquidated so they can return money back to the partnership. In fact, I want to, there's one other, let's talk a little bit more about this and just understand the economics of venture capital. It's interesting, most venture capital managers live off of fees. And the reason they do this, so in a way, they don't really care when the exit comes. So it's something like, I've seen different stats on this, but it's something like 70% of venture capital funds who never receive carry, they only receive fees. And the reason this matters when we're talking about this is you could sort of think from the venture capitalist point of view, if carry was important to them, then it is, I mean, this is one of the things which drives the fixed term, is that the VC wants to see when is the time I get my carry back. But in a way, they sort of don't care. And the reason they don't is that VC deals are individually risky. 2/3 of deals are going to fail. And the bulk of your returns comes from the home runs, which is 1 in 25 deals, 4% of the returns who give you 10x or more. The result is, if you take this distribution, you run it through a Monte Carlo simulation, you get results which match very much what the industry sees. And the industry as a whole says, hey, venture capital funds get a distribution like this according to Cambridge Associates, where if you have a hurdle rate of something like 7%, there's a significant fraction of VC funds which will never make carry, and then a bunch that do. And the numbers I've quoted you are all over the place because VC returns aren't public. So according to Cambridge Associates, maybe 40% of VCs will never make carry. And yet, according to other published data, 70% of VCs never make carry. And this is just a reflection of the data being a little bit confusing. In any case, this is good underlying math to be aware of in how VC funds work. And there are a number of VCs who will want smaller funds to generate this potential upside. And you will notice you could take, as a venture capitalist, if you do sort of 200 random deals, you have a much tighter distribution of returns. However, some VCs may think it's in their interest to have a small number of deals, hope that they get one of these home runs, 1 in 25. If they do, they get big returns and big carry. I talked about the sort of the assets being illiquid. If you start to look at it from the point of view of an investor into the fund, your standard VC fund timeline looks something like this. A VC will spend about 2 years fundraising. You will then invest on the close, a first or second close, whenever you invest in the fund. And they go through this investing period. They then go through their managing and exiting period. In this investing period, the venture capitalist will do things called capital calls. So they know that having a 1% return on uninvested capital drives down returns. So they basically say, look, there's capital calls, pay the money I ask you on demand. If you don't pay it, there's penalties, you lose the investment. The other thing that happens here is when the fund closes and the VC has to return money back to the investor, they're forced by the rules of the fund to exit out of their investments. So they will often sell to secondary markets. One big group who does this is Collar Capital. And when Collar Capital is buying assets from VC fund, which is closing, because it's a private company, there's a lot of unknowns. And the result is you'll typically end up taking about a 30% haircut. So this is really interesting when you think about it from the point of view of the investor. Here I am investing in a fund. The fund is illiquid because the assets are illiquid. But hold on a second, the assets aren't really illiquid because at the end of the year life of the fund, they are being sold off into a secondary market. So clearly they're not fully illiquid if you're willing to take a haircut. But in any case, I'm investing in this fund where I'll have a 30% sort of cut on my returns at the end of the life of the fund. And I'm going to be obliged to hold capital in reserve and invest it every year into the fund. And if I don't, there's massive penalties, potentially including the loss of all money invested to date. So if you think about this from the investor point of view, it's a really constrictive situation to live in, which is perhaps a little suboptimal for returns. So if this is the case, then of course you start asking the question, does it really need to be structured this way? So the first thing to think about is, and Michael and I, when we launched our fund, we really said, look, we wanted to give other people the opportunity to get what we would want for ourselves. And in our case, we sat there and said, this is ridiculous. We would never invest in a venture fund where our money was locked away for 10 years, where in addition, there's capital calls. And in addition, there's going to be this sort of penalty at the exit on the other end. So this does open up the question, if you can't trade the fund back and forth to strangers because strangers don't know the value of the asset and they're always going to discount it, why don't you set up and run a fund where you do secondaries in your own fund? Because you as the manager of those assets know the quality of your own assets. So why not think about doing that internally? Now, if you start looking at doing that, you run into a significant problem on pricing. If you look at pricing the way pricing is done right now in VC funds, pricing is an administrative exercise governed by the accountants and the auditors, where what they're looking for is simple, conservative, defensible rules. If you're an accountant and an auditor, you are pricing to be able to prove it if and when challenged and to protect yourself. Now, if you want to sort of engage in trading where you are looking to sort of buy and sell at the true market price, you would sort of say your number one goal should not be protecting yourself. Your number one goal should be accuracy. What is the most accurate price? What would I pay to buy today? Now, these sound like in many cases they could be the same thing, and I'll get into it in more detail in the next slide. But let me give you a couple of simple examples here of what this means to price like a trader rather than pricing like an administrator. When you're the administrator, the simple rule to use is to hold an asset at cost if it's not impaired. And almost all venture and private equity funds will do that. So you hold it at cost unless it's impaired. If it's impaired, of course, you mark it down. The result is, and at times that can be a very good rule to use, but companies can over or underperform relative to what you thought they would do when you initially invested. So if you want to price like a trader, you should really be adjusting that original cost price based on the performance of the company. If it's underperforming, it's not impaired yet, but it is underperforming, mark it down. If it's drastically overperforming, mark it up. A second thing which is really commonly used in this industry, and in fact, I think it's an underlying challenge in the venture industry as a whole, is there is an accepted rule which says when there is a follow-on investment, use the valuation of the subsequent round to mark up your asset. Superficially, that sounds really sensible. What we see, however, in venture capital is we see that each subsequent round is a preference round where the new investor gets preferential terms compared to the earlier investor. And the result is, yes, they've got it, and people know this, that if you write good preference terms in, that effectively decreases the headline valuation that you are giving, because you have the preferences actually give you real value. There's actually a study out of Stanford University and UBC, Gornell and Stribolev, which said that on average, unicorn valuations, their headline valuations, were 48% above the fair value when they actually listed. And if you want to know what the real value of an asset is, then you should really be looking to adjust the valuation to factor in the deal terms. Another thing to look at is, look, if you're an administrator and there's a new funding offer, you're going to ignore it until it's closed. When it's closed, you'll use it. If you look at the public markets, in the public markets, when there's an M&A offer or acquisition offer, funding offer, you will see the price move towards, but typically not hit that offer value. So you need to start to do things like estimating the probability of the offer closing. So these are some of the changes. And really, if you want to look in more detail, Loyal has drawn up sort of valuation principles that we use to try to mark to market. We would love to get feedback and discussion on this. But the thing is, most people are looking for a fair price. And Loyal sits there and says, well, if you want to get sort of trading, you need a fair trading price, which is fair to both buyers and sellers. Now, pretty well everyone agrees that the recent transaction is the strongest indicator of the market price. And that is what we will do. If you look at what a standard valuator will do, they'll then say comparable companies should have comparable valuations. We agree. They will look at market comparables as a primary. They will look at the industry, how that's going up and down. And these will be primary factors where a recent transaction is not available and where you want to take a step beyond holding it at cost. Loyal looks at this and says, okay, these are secondary factors, but fundamentally, when you're looking at the early stage, valuation should be based on scenario analysis. And the industry as a whole says, yeah, scenario analysis matters, but that's too hard to do. Therefore, we're going to ignore it. We're going to look at market comparables because those are easy to find, and scenarios, you can't really use it. Yet, the scenario is really the truest way to value a company. So we have a series of things in there you do. Let me just sort of press pause there and highlight the takeaway from this is, if you want to move VC out of an illiquid asset class into something with more liquidity, you need to do valuations, and you need to do valuations which are a true market valuation, that they are not a number which an accountant writes down to defend their reputation. You need to really think like a trader. So great, if this is the way to sort of, if you can start talking about, you can have secondaries in a fund, you can start to do the valuations. One of the things many people say is, why don't you just use blockchain for trading? How do you make a VC fund illiquid? Stick it on the blockchain and then put it out there for people to trade publicly in it. And in fact, there's a group called Funderbeam who has been up and running for, I think, probably a decade right now, where global marketplace of growth companies, 70,000 growth companies on there. You will notice, however, that although Funderbeam has 70,000 people in the community, they've only got 80,000 trades completed. So we're talking about around one trade per community member. And the real problem here is blockchain is absolutely a great solution for administration to manage trading efficiently. But there's a big challenge here with private companies where you have a massive knowledge disadvantage. When you have a buyer and seller, and the seller knows the asset and the buyer does not, and because it's private company, the information flow, the buyer is always suspicious about their information flow, the result is going to be relatively few trades because there's always a risk of market manipulation. So if you want that trading to work back and forth, you really need somehow to have a knowledgeable party involved who is rewarded for accurate pricing. A knowledgeable party with full access to information about the companies traded, and who really their compensation is based on they get the price right rather than anything else. So Loyal has actually been doing this with our own fund. We've been running for the past 3 years. We do quarterly pricing. We typically have 10, 20, 30 purchasers each market. And a lot of times it's existing investor, half that money is existing investors. I'd love to tell you how well our trading has been working. I honestly can't because we're too successful to date. Our ROI annualized is over 40% recently. So the result is nobody's wanted to sell the assets. And if you have no selling assets, you don't have much of a marketplace. But I will mention one thing we do, for instance, which was very interesting. And I will give an example here of what it's like to mark to market. In March of 2020, for those of you who remember what was happening at that time, the markets were frozen, and we did a pricing of all of our assets. And we came out, we said, given the change with COVID and what's the prospects of all the markets, here's the new price we think all the assets should be. And we brought that to our LP advisory committee. And then we said, and in addition, we recommend an additional blanket 10% discount to the price. And the LPAC, all the LP advisory committee, sat around the table and turned to us and they said, why would you do that? You figured out the assets. The fund value is worth what the assets are worth. And that is absolutely true if you're not thinking about mark to market. But we were in a market situation in March of 2020 where everybody was holding on to cash. Nobody wanted to trade out of cash into any asset, and assets were all trading at a discount to what their value were. So we said, if you want to get someone to trade out of cash into an asset, the market price, you need a 10% discount. And they all said, no, no, no. And we looked around the table, we said, how many of you would invest more money in the fund right now at the headline price? And the hands stayed down. And we said, with a 10% discount, how many of you would invest? And one person put his hand up and we said, that's what a market clearing price looks like. So you do need to do awkward things, which are hard to justify sometimes if you think about markets, because markets are irrational and you need to be comfortable pricing the asset to what a market behavior would be. There is another way to give liquidity to funds, and I will toss this out there. It's something we've discussed, we haven't done ourselves, but you could also make VC a more liquid asset class by having a cash cushion, holding cash in your fund to provide a float that would allow for redemptions. You could hold, for instance, 20% of cash for redemptions, and that would allow you to do a more frequent liquidity. I mean, Loyal prices quarterly because it's a lot of work to price a whole bunch of private assets, and we price 200 private assets on a quarterly basis. It's too much work for us to do that monthly. But you could enable, our fund could enable monthly liquidity, which is more like what you expect to see from a hedge fund. And this is a strategy that venture funds could provide to provide some liquidity. The two big challenges of that are, number one, it drops your returns from, if it's 50%, whatever it is, but it's going to drop your returns downwards, average downwards, because the cash has lower returns. And the other challenge behind that is liquidity is most desired during periods of market panic. So a 20% cash will allow smooth purchases and redemptions in an ongoing manner. But it does mean that as soon as there is a market panic, that your 20% will probably be sucked up pretty quickly unless you're willing to discount the value aggressively at the times of those market panic, as I mentioned a little bit we did earlier, and that is another potential solution. So yeah, let me sort of stop there. Talked about, does venture capital have to be illiquid? No, it doesn't. It's simply a choice. The underlying assets are illiquid, but there's liquidity already in venture funds when people trade out towards the end of the asset life to a secondary market with collar. People like collar capital. So yeah, you could do that same trading. The challenge behind doing the trading is the pricing knowledge mismatch and the willingness to do a true market valuation. If you do a true market valuation, then you can start to have trading. If you want to do the trading, there's a couple of different ways to do it. There's just sort of price and trade, you can also add additional liquidity with a cash cushion. But let me just sort of stop there. This is sort of an ongoing conversation, and would like to have both questions from everyone on the call, and or I'll be very open to sort of discussion back and forth from those who have thought more deeply about this or are experts in space. Just to start things off, is there anyone here who's ever asked themselves, why is venture capital an illiquid asset class? Does it really need to be that way?
Hey, Kamal, no, I
Yes.
did not ask myself that question, but if you will, I can ask a question. If you go
Please.
back to the to what you were describing at Loyal, where indeed like you have people who invest on a quarterly basis, but no one who sells. My question would be, if there's no one to sell, what is liquid then? Is it like you're creating like more shares every quarter for investor to join in, or
Yes.
like you have a limited pool of shares and so people can join in, and if someone wanted to sell, then instead of creating that amount of share, you would just sell the shares. Is it the way it works?
Yeah, that's correct. We keep creating new shares so people who comes in, and if there were some people who were selling shares at the same time, you would create fewer shares. And some of that cash, I mean, that cash would ultimately leave the fund. When you create new shares, cash enters the fund. Whereas when buyers and sellers transact, you're not creating any new shares. So the money, rather than going into the fund, is going into the pocket of the seller from the buyer.
Thanks.
Kamal, this is Vignesh here.
Yes.
Just a question on that answer, actually, so the seller can sell it with added premium. Is that what you're saying?
So the way we've set our fund up is that we have said, and of course, I mean, if the seller could sell without a premium every quarter, you risk having you risk having very active trading activity. So certainly the way we set our fund up is we ask all sellers, there's a restriction that you not sell within the first 2 years. And there's a premium, a 5 to 10% premium, which you pay if you sell in less than 4 years. Now, of course, a 5 or 10% premium should sound pretty good when you compare it to the 30% premium you would normally pay. And in fact, we are permitted to have people sell in less than 2 years in our fund with a 15% premium and permission of the manager. So that is something we thought was useful to put in to sort of try to manage the market a bit and ensure that people were trading in and out because they're thinking of their long-term asset allocation, and they're doing it because to just sort of keep their assets balanced, rather than they're doing it because they want to jump on trading each quarter. So that's what we did in our fund. I mean, it is an interesting question. We didn't necessarily have to have those rules. We could have just said we'll be open and trading immediately. And you could argue that it might make sense to build a fund which didn't have those liquidity restrictions and didn't manage the trading in any way.
Thanks for that explanation, Kamal. Yeah, because this is much more much better, because otherwise there'll be a lot of speculation and it'll be like a trading, like you said, right? We make it like trading, and that kind of explains a lot. And I think it'd be interesting for the funds. Is there a minimum size for the investment and things like that, for the fund?
So in our fund, the minimum investment is $100,000 for financial investors. We do lower that if someone's an advisor who helps advise the companies.
Thanks for that, Kamal. Yeah.
Kamal, just to clarify that, you're not guaranteeing that there is a market.
That is correct. We are, and that is the thing precisely with all markets, is it's a trade. Now we have never had a quarter where we have been unable to raise funds so far, even in the March 2020, as you saw, we priced in order to be able to keep raising funds. But you could hypothesize that there could be a market situation. where nobody wanted to buy, nobody wanted to trade in. And if there's nobody wants to trade in, then there will indeed be unable to trade. And we always, I think that is the solution always, is if you're going to have a market, sort of use a market mechanism to deliver liquidity, there can never be a guarantee because it's always done via trading. And fundamentally, as the market maker, if you want to make the market, you have to be willing to discount the asset down to the level at which it is purchased. So those are sort of the two essential rules of liquidity via marketplace. You need to have buyers. And if you don't have enough buyers and you have too many sellers, then clearly the asset is worth less than you thought it was, because you need to price it down to get the market to clear.
There's a question that I just got on my phone that, when we say that there needs to be a market, then what is generally the average period before which one can finally sell?
So the way Loyal does things is Loyal does things with if there are too many sell orders, not enough buy orders, we will fill the sell orders pro rata. So you might fill, in the worst cases, I don't know, you might fill 30%, 50% on the first quarter. And then we would continue to sell. You have priority on sales in the remaining quarters. Now, the nice thing about Loyal is whenever an investor sells, in fact, we have two management fee structures. We originally started the fund with a management fee structure that we only received management fees when the investor bought or the investor sold. And that gave us a very, very strong incentive to mark to market, because we don't get a management fee for holding assets. We just get it when the investor sells. We have moved away from that management fee structure just because nobody understood it in the marketplace. So we've moved to a traditional 2% annual. So depending on who the seller is, we have potentially a very strong financial incentive to mark to market if some of the sellers are existing investors, or less of an immediate financial incentive. As a VC, though, you still get your chance to access carry. And when you're in an environment where your fund has been increasing in value by 40% a year, then we're going to get a percentage of the profit when people sell. So we are highly motivated as a market maker to get a trading price set up which allows the sale, which means we are incented. If we can only sell half the units in the first quarter, then we're pretty incented to get the price marked to whatever we need to price it to get more to sell in month 6 and month 9. And of course, if you're an existing holder and you're saying, well, hold on, you're marking the price down because there's too many sellers, maybe I should, what are you doing? Then the answer is, well, you think we're marking, we'll tell you transparently, this is what we're doing the price. And if you think it's too much of a discount, we'll buy more. And that is precisely the environment. That's the market mechanism sort of in micro action of you price it down until more people want to buy, and then buyers and sellers match. Because it's a wonderful buying opportunity for buyers if there's a lot of sellers and you have to lower the price to fill the market demand. It's interesting when you look at sort of market mechanisms, we're all used to the market. It's just like, yeah, of course, supply and demand match in the market. But when you think about the reality of what market mechanisms look like, they can be very, very uncomfortable. So for instance, we've sit down with our limited partner advisory committee, and we're looking at the prices of assets. And we have assets in our portfolio, individual companies, where the price has yo-yoed up and down over a quarter-to-quarter period, where they will raise new money at a financing of a valuation of the company at $15, $20 million. And we say, and that is the market price. So we mark it up to 15, 20 million. And then we're sitting there looking at the value of the company, the way they're performing. And we're saying this asset is really only worth 8 million. We have no idea how they got 15 million. We have to mark to 15 million because they got it. And 3 months, 4 months, 5 months later, if it's been 3 or 4 or 5 months since the last transaction and their performance continues to be poor, then we will mark them down. So the asset will jump from 15 million to 8 million to 15 million to 8 million back and forth. And that looks really messy. But that is actually what marketplaces look like in general, is marketplaces have funny behaviors from time to time. And we are following our valuation rules, which is a recent transaction. If someone's willing to pay that, that's what the asset is worth. But if it's been a while since the asset has last traded, let's start to look at performance. And in fact, that company, which has been jumping up and down 15.8, 15.8, recently was talking with us, and it looks like they're now looking at raising money at a valuation of closer to 10 million. And so we can see that this probably over time is reverting down to something, but down to closer to what we thought the true value of it was. But if someone closes a financing of 15 million, it's sort of worth 15 million because that is what the market paid for it. And that is why markets look crazy and messy every day, is they are unpredictable because they have these unusual behaviors. Any other questions around sort of VC and these sort of thoughts around making VC a more liquid asset class? And we have been giving you a look under the hoods of what of what's involved. It can be a little bit messy, but it is sort of essential if you want to do this. These are the sorts of things you do. And honestly, we think this is far better than holding the assets to term, having a 30% discount, being forced into a 10-year holding period, which may not work for you, and having capital calls. And the only way around that is to mark to market and to mark to a true trading valuation. And if you do that, then all of a sudden you can start looking at liquidity.
Can I ask about the structure?
Sure.
Well, thank you so much for the presentation. I would like to ask about the structure for the fund itself. It is some funds, they use SPV in some cases, and some of them they use partnership approach and structure. Can you? I'm not sure about Canada. This is what I know about US, but can you tell me and tell us and give us information about that somehow?
Sure. Yeah, so look, Canadian law is a lot like US law. We are neighbors. We copy a lot from them. We are a limited partnership. The reason we want to do a limited partnership, if you just want to look at sort of liquidity and trading, it's a lot easier to have one asset which is continually traded. And we simply, anytime there's a new investment goes into the fund, buying loyal VC is a lot like buying a mutual fund. And we can do this because of liquidity, which is you buy a piece of all of the prior assets because you're paying a market value for all those prior assets. And your money is going into a fund which will make a bunch of future investments. So you're actually buying an instantly diversified portfolio of past assets plus a piece of every future investment the fund is going to make until you exit. And that sounds really confusing when compared to an SPV, which is just my money goes in, it buys these specific assets and I'm done with it. But this is, we believe, sort of more advantageous as an investor to not be locked into only a few assets, but to actually be able to buy the whole portfolio all at once. And all of this is possible because of mark-to-market valuations and the implied liquidity.
Okay, when the investor, he would like to sell his equity in
when the investor wants to sell, there's a price. We set a price every quarter, and the investor simply says, okay, the price, I mean, our price, yeah, I bought it at a price $1 a unit. It's now $1.50 a unit. I'd like to sell. It's like, great, you want to sell? It's $1.50 a unit. You can sell.
Yeah, but there is no commission.
If you hold it 4 years, there is no commission. If you hold it less than 4 years, there is a commission.
Okay. Okay. From your experience about the structure in US.
Kamal, if I may ask a question. I mean, you talk a lot. sorry. You talk a lot about the market, but the market could consist of one individual or one company which puts in one investment into a given firm.
Absolutely.
Now,
And
that, of course, opens up to manipulation, right? How do you manage that?
Absolutely. That is one of the things which we look at when you say the recent market transaction. You also look at if that's a bona fide market transaction or if that is a manipulated market transaction, because clearly you could use bona fide ones for value, but then manipulated ones, not so much. And that's one of the things you're always looking at. Like the company I was mentioning, they have multiple third parties investing, but if it's an existing investor, for instance, investing one amount to hit a transaction, it doesn't make a lot of sense.
Yeah, but to judge that over 40 different countries cannot be easy.
Yes and no. So we have an advantage in terms of we invest only in alumni of INSEAD and graduates of the Founder Institute. And we do personality testing of the entrepreneurs before they come in. So the personality testing tends to flag people who are more likely to be deceptive. It's one of the things you're looking for. And when people share a network with you, they are more likely to be, when they share a network with you and when they are in a long-term relationship, they are more likely to be honest, because being dishonest in a long-term relationship is generally not a good thing. In a short-term one-off transaction, this is the good old prisoner's dilemma, one-off prisoner's dilemma, be dishonest all you want. The long-term one, you better learn to cooperate. And also they know that if they lie to us, they aren't just hurting their reputation with one investor. We are so connected into their ecosystem that there is a risk that has a sort of a larger impact on them. So the result is, because we're investing in an area, in an environment within this network, with this trust, with all these incentives to be honest, you can often, well, you can rely on people to be honest, knowing that you're always checking and knowing that if they're dishonest in one way, they'll probably be dishonest in others, and you will find that out over a multi-month relationship. So when we invest, we put $10,000 in to start with, and we do a pilot period, which is a median of 10 months before any more money goes in. And we're doing ongoing diligence to watch for and check for, is this person honest? And then when you can see that they're honest, and we continually watching that, then when someone says, oh, I got some new money invested, we say, well, who was it? Are they related to you? How many investors were there? And where you're in an environment where you can rely on honesty there, then you will tend to get honest answers back, and you don't need to validate and check those. You don't need to validate and check everything someone says, because you are continually checking every month, spot checking, spot auditing things they're sharing with you.
Come on,
Yeah.
From your experience, in creating fund structure.
Yes.
Is it easier in US to do it or in Canada? I know you are based in Canada, but some people, from your experience, this is legal stuff, and how is fast, and what's the best option in Canada, and what is the best option in US?
So I would say that they're both good options. US is more accepted, understood, and there's more template environments available to create a fund. In fact, there was just a free template released by the Founder Institute, one of the groups we're partnership with. They've released a free limited partnership template for US law. The problem with the US is US taxation. If you are a non-US citizen, the US has a view that they will tax you around the world. And if you are a US fund, you have a lot of US complications. People will often set up a feeder fund in the Cayman Islands to invest into the US fund to exempt foreign limited partners from US taxation. And Canada does not have that. Canada taxes by residents, so non-resident LPs are not taxed, whereas in the US, they think a little more broadly about taxation.
But about taxation, I am aware about that in US, if you are non-citizen, but if you are limited partner in the fund, they will not take anything from you, especially with the capital gain. But if you are, I think you talk about, if you create a fund as a limited partner, there is a tax here for you, even if you are not citizen there, right?
So I don't know about the exact rules. I do know when we were setting it up, we received advice that there were many limited partners, foreign limited partners, who would simply refuse to invest in a US fund because of tax obligations. And I think sometimes it's just tax filing. They may not even have to have tax necessarily, but taxes withheld and they need to file taxes in the US to get it back. And I don't know which of the cases it is, but I mean, we don't want to ask our limited partners to have to file US taxes if they don't have to do it otherwise. I mean, why do you file US taxes for one tiny investment? It makes no sense.
But that's mean here in Canada, much better to do it than US to avoid this challenge for US citizen or non-US citizen too.
Yeah, we don't have the tax problems. So we don't have the tax problems. It's a good jurisdiction. It's simply, it's less accepted. I mean, we often joke that Canada has the taxation of the Caymans and the governance of Canada. But as far as a limited partner is concerned, because Canada does not tax non-residents, that is effectively what happens.
But if you create, for example, now Loyal VC, they are a fund in Canada. Once you invest outside Canada, how is the flexibility for you as a fund manager? It is easy for you to invest outside Canada. There is no challenge.
There are really two countries in the world which make it challenge. So generally speaking, right, there's probably 3 big countries in the world where it's a challenge. For 200 plus countries in the world, they don't care if money's coming from outside into their country to invest in companies there. The 3 differences are in sort of varying order of difficulty: India, Brazil, and China. So if you want to invest in India, Brazil, and China, and there may be, I mean, places like Myanmar, we've never invested there, they may also be difficult. But basically, it doesn't matter who you are. If you are not local in India, Brazil, and China, it is challenging to invest. But other than that, it doesn't matter if you're a Canadian fund, American fund, or an Emirati fund, and you want to invest in pretty well any country in the world, go for it. Nobody's going to stop you.
Well, what about the SPV as a vehicle to use it for some deals in Canada and outside Canada, for example? How is that easy to structure it in Canada? It's much easier than US?
It's exactly the same as the US if you want to do an SPV.
And even the pricing is same or lower or expensive? It'll
be cheaper in the US because there's some big funds in the US, big groups in the US who do SPVs off the shelf, and they just roll them out for like $1,000. I think AngelList does that. So it's a lot easier there.
Okay. In Canada, still nothing like AngelList who will help with that.
There may be, I honestly don't know. For a number of these questions, by the way, Waleed, feel free to email me at kamal@loyal.vc, and we can set up a time to discuss these particularly, because we are getting a little bit off topic on the liquidity.
Thank you.
Yeah. Good. Any other questions about the sort of liquidity, thinking about making VC an illiquid asset class? All right, well, perfect. Well, thank you very much, everyone, for attending. It's been great to have you. Hope this has been useful. And if you have think of any questions or challenges afterwards, do let me know. It's something we're sort of experimenting with. We're still learning from, and we'd love to get your thoughts and feedback to keep improving.
Thanks. Yeah.
Thank you very much.
Thank you.
Goodbye, everyone.
Thank you.
Bye.